Welcome back to The Deep Dive, the show that gives you the shortcut to being well-informed. Today, we are taking a really close look at the global automotive titan, Toyota.
That's right. We're getting into their FY 2026 second quarter financial results, which just dropped in early November. And we're really focusing on three critical questions that those documents raise. First up, how resilient were their financials? I mean, given the massive global pressures.
And we all know what that biggest pressure point is, the U.S. tariffs.
Precisely. The second thing we need to tackle is their strategy going forward. We're talking about the big push on hybrids, the newly clarified five-brand structure, and of course the integration of their new software platform, Arene.
Right, and then the third piece, the internal threat, the one they identified themselves.
Yeah, the sharp rise in their operational costs, specifically what they call their break-even point.
So our mission today is really to unpack the central contradiction. Toyota took one of the biggest financial hits in its recent history, but they still managed to revise their full-year profit forecast upward.
It's a fascinating story. It's operational efficiency versus geopolitical headwinds.
Okay, let's unpack this.
So let's start with the financial scorecard.
Yeah.
This is for the first half of the fiscal year, so April 1st to September 30th, 2025. Sales revenues hit 24.63 trillion yen.
And just to put that in perspective for everyone, a trillion yen is what, roughly $6.5 billion US dollars?
Something like that, yeah. So we are talking about absolutely massive numbers here. And that revenue figure, it's a solid 5.8% increase year over year.
Great top-line growth. So people are definitely buying the cars. But here's where we see the first sign of trouble, right, in the margins. The operating income, or OI, was 2.0 trillion yen.
Which still sounds huge.
It does, but it was an 18.6% drop compared to last year. So that means external cost pressures just ate up over 450 billion yen in profit, even with sales going up.
And the sales volume definitely backs up that revenue growth. Consolidated vehicle sales, they grew 5.0% year over year, hitting 4.78 million units. So the demand is there.
Driven mostly by North America and Japan, I saw.
Exactly. The product power is absolutely there.
But despite that big dip in operating income for the first half, the big news was the full-year forecast. Toyota raised its operating profit forecast from 3.2 trillion yen up to 3.4 trillion.
And that's the moment that really caught investors' attention.
It is.
But there's important context here. While it's an upward revision on their own forecast, that 3.4 trillion yen is still a steep 29.1% decline compared to the year before.
Oh, right. The astronomical 4.79 trillion they earned in the previous fiscal year.
Exactly. So this isn't really a celebration. It's more of a mitigation success story. Their full-year revenue, by the way, is now forecasted at 49 trillion yen.
Okay, so if they're facing such heavy margin pressure, what's the one single factor that's just dominating their expenses? And how on earth are they offsetting it enough to raise that forecast?
Well, that single factor is, without a doubt, the U.S. tariffs. Toyota is projecting the full-year negative impact from these tariffs alone will be 1.45 trillion yen.
Wow. In U.S. dollars, that's getting close to $10 billion.
It's one of the largest single financial hits they've had to absorb in a long time. For the first half, the impact was already 900 billion yen.
So the thing you have to realize here is that they expect to make a 3.4 trillion yen profit while absorbing that 1.45 trillion yen hit. I mean, that's just astonishing. It means some deep operational strength is neutralizing nearly half of their entire negative forecast.
And that strength, according to them, comes from strong demand supported by product competitiveness and these really aggressive improvement efforts. They didn't just jack up prices.
No, they focused internally. They pushed for volume, a better model mix, and serious cost reduction.
The numbers back that up. Toyota's aiming for a combined positive impact of 0.9 trillion yen from these internal efforts for the full year.
They're literally fighting a trade war with efficiency.
They are. But we have to talk about the unsung hero here, which is the value chain profit.
Okay, explain that.
This is the super profitable revenue they get after the car is sold. We're talking service, financing, used car sales, spare parts, that whole ecosystem.
And that's a big business for them.
It's huge. This business line has expanded to where it's delivering annual operating income in the order of 2 trillion yen.
Wait, hold on. Let's pause on that. You're saying the profit they make just from the service and maintenance ecosystem of their cars, the value chain, is bigger than the 1.45 trillion yen tariff hit they're dealing with.
Absolutely. And this isn't just about selling parts. This is tangible proof. that Toyota's reputation for long-term durability and high resale value, it acts as their ultimate financial shock absorber.
Because the cars stay on the road, generating high-margin revenue for years and years.
Right, it makes them financially resistant to a lot of these short-term market shocks.
And you can see this play out geographically, can't you? North America actually swung to an operating loss in the first half.
Yep, mainly because that's the region absorbing the brunt of the tariffs.
But other regions are showing that balancing strength. Operating income was up in places like China and Asia, driven by more sales and a better mix of models.
That global balance is what keeps that 3.4 trillion yen target within reach.
Okay, so before we move on to what this all means for their future strategy, I think we need to take a quick pause for a critical reminder.
Yes, definitely.
We want to be absolutely clear. The information and analysis we're sharing here are purely to help you understand the market and are not investment advice. Investing involves risks, so please ensure you do your own homework or consult a professional financial advisor before making any decisions.
Okay, so if the present is all about fighting tariffs, the immediate future is defined by one thing: hybrids.
Right.
In the first half, the ratio of electrified vehicles, what they call XEVs, climbed to almost 47%. And that growth was heavily weighted toward hybrid electric vehicles, HEVs.
The HEV sales alone jumped 9.3% year over year. So Toyota is betting big that this strong customer demand for hybrids, especially in North America and China, is going to keep providing the cash flow they need.
It funds the whole transition. Now let's look at the purely electric side, the battery electric vehicles, or BEVs.
Yeah, what's happening there?
Well, BEV sales saw really strong percentage growth in the quarter. But the company was very candid. They admitted they're short of their own initial expectations.
But they're sticking to the long-term target.
They are. They're sticking to their 2030 target of 3.5 million BE units. But it's clear they're prioritizing finding the right product for the right time over just rushing volume out the door.
Okay, but isn't that a pretty significant risk? I mean, while they're relying on the HEV cash cow, you've got major competitors pouring billions into establishing pure BEV market leadership right now.
It is a risk. It's their multi-pathway approach in action. They see the HEV as the bridging technology. It gives them immediate emissions reductions and, crucially, profit.
Which then funds the slower, more expensive shift to things like solid-state batteries.
Exactly. And the $912 million investment they announced right after the earnings report confirms this.
I saw that. That's going into 5 U.S. plants, right?
Specifically to increase hybrid capacity. And they're even bringing hybrid Corolla production to U.S. soil for the first time. That is a concrete commitment.
So beyond the engines, they're also clarifying their structure. We're seeing this 5-brand strategy really crystallize. Toyota, Lexus, Daihatsu, GR.
And the newly established Century brand, they're positioning it as the absolute pinnacle of Japanese luxury. It's all about meticulously segmenting the market.
And underpinning all of this is software. Toyota is pushing hard on its software-defined vehicle, or SDV, strategy. They're using their internal Arene platform for more efficient software development.
And here's where the strategy gets really smart. It connects today's profits to tomorrow's potential. The new RAV4
One of their global bestsellers, millions of them on the road.
is the first vehicle to adopt the Arene platform.
That's a huge move. Choosing the RAV4 as the software testbed is, well, kind of genius.
It connects their current cash cow, the one that feeds that massive value chain profit we talked about, with their future digital ecosystem.
It creates a virtuous cycle, doesn't it? They can leverage that huge volume and all that global data to refine the software, which then strengthens their whole profit base through new services. Okay, so we've established they are resilient against tariffs, and they have a clear, immediate hybrid strategy. But the final challenge is a structural one, an internal one. The rising cost base, which they summarize with the increase of their break-even point.
Let's define that clearly. The break-even point, or BEP, is just the volume of sales you need to cover all your fixed costs.
So things like factories, R&D, salaries.
Right now, tariffs are essentially a forced fixed cost.
And their internal warning was that this BEP has risen significantly over the past 2 years. Why is that?
It's a combination of, you could say, necessary evils. One, they're making huge comprehensive investments in future tech. Massive R&D spending on platforms like Arene and next-gen batteries.
Okay, that makes sense.
2, they're investing heavily in human resources, trying to develop all that software talent in-house. And 3, the U.S. tariff burden just makes every fixed cost look even bigger.
So they can't stop investing in R&D, and they can't just stop the tariffs. How do you reverse that kind of dangerous trend of a climbing break-even point?
They've launched a company-wide initiative. And it's all focused on, well, ruthless efficiency. It's an exercise in cultural transformation.
What does that look like in practice?
They're reviewing the allocation of people, materials, and capital. They're pursuing what they call waste-free, value-added work. And they're explicitly trying to eliminate wasteful tasks.
The bane of corporate life. I think I saw one of the specific examples they cited was eliminating inefficient meetings.
You saw that too. Toyota is now officially declaring war on the status update meeting.
I love it.
Exactly. Every meeting, every process, every dollar has to justify its existence. And this initiative is crucial because if they don't get their BEP down, all that future investment they're making is going to become an anchor on future profitability.
And finally, just a quick note on shareholder returns. Despite this tough year, Toyota reinforced its policy of stable and continuous dividend increases. They're forecasting a full-year dividend of 95 yen per share.
So they're managing current expectations while funding that massive future.
Okay, let's wrap this up.
So to summarize this really complex picture for you, here are the 3 critical takeaways from this deep dive.
Go for it.
Number 1, resilience versus tariffs. Toyota successfully offset that massive 1.45 trillion yen tariff impact. They did it by leveraging immense product demand, generating 0.9 trillion yen in internal efficiencies, and crucially, relying on their high-margin 2 trillion yen value chain business.
Durability equals profit.
Exactly. 2, the hybrid hedge. The immediate strategy is all in on hybrid electric vehicles. That $912 million in U.S. plant expansions confirms this is their profitable strategic bedrock, and it's allowing them to be cash flow positive while they take a more cautious, calculated approach to the pure BEV market.
And the fair point.
The operational pivot. Long-term success now hinges entirely on reversing those rising fixed costs, that climbing break-even point. Their future depends on how quickly and effectively they can integrate new tech like Arene and the RE4 to justify.
Which leads us to the ultimate question for you to think about. Toyota is deliberately raising its long-term fixed costs by pouring money into R&D and new platforms. They are betting that the successful integration of that tech, plus this ruthless pursuit of efficiency, will eventually deliver a disproportionate market share and profit.
The big question.
Will the Arene platform and the 5-brand strategy create enough of a competitive edge to justify this massive, costly investment phase and ultimately bring that break-even point back down to a comfortable level?
That is the ultimate test of their long-term, product-centric management philosophy in a world that is changing incredibly fast.
Thank you for listening. We hope you enjoyed today's content. We'll see you next episode.